Welcome back to P2 ACR. We continue with basic groups. We continue Chapter 1, Basic Groups. So far we've done an introductory question, just the one introductory question, a wonderful basic question called PEDAL. It's parent, subsidiary and associate. Now that truly is the most basic of basic questions. There is still a relatively basic technique that we need to superimpose on top of that, and that is goodwill impairment. Goodwill impairment occurs when there is an impairment in a subsidiary. It certainly doesn't happen in every question. It does not happen in every question, but it is a relatively frequent paragraph within the P2 examination. So I guess we should be able to do it, right? I have two illustrative questions on the subject of goodwill impairment. The first one is so ridiculously easy that you could almost argue it's kind of no more than a little insight into the elementary goodwill impairment. It's called Faken stock. The question is called Faken stock. The real question is the one just below called terror. We're still in Chapter 1, we're still doing basic groups, and our first question is the question Faken stock. As you can see from me looking down here, I have my copy just to my left, and here it is here from my notes. Okay, so let's go. Shall I put a basic title? I think I'll put a basic title, just as if I was teaching you in the classroom, right? So it's goodwill impairment. Goodwill impairment. This occurs when subsidiary recoverable value falls below carrying value. This occurs when subsidiary recoverable value falls below. Did I say that right? This occurs when subsidiary recoverable value falls below carrying value. I suspect that probably doesn't mean very much to you at the moment, but it will once you've done the first illustration, which is called Faken stock. It's a good starter. Gets you going in the right direction. So, Faken stock in Chapter 1. Faken stock. A parent, Faken stock, bought 100% the entire equity of a sub at the year's start for 900 million. Share capital was 100 million, reserves were 400 million, and the retained profits for the year were 200 million. Goodwill has an infinite life and is Goodwill has an what? Goodwill has an infinite life, and an impairment review of the sub at the first year end revealed a value in use, VIU, a value in use of 780, and a net realisable value, NRV, of 350, and the requirement is goodwill. Well, I don't think I want to really talk too much about that because it's not immediately obvious what's going to happen until you start to bash it out. So let's do that together. The first thing is, in order to calculate goodwill, is that you need to do the net assets working, right? So let's do the net assets working. This net assets working never changes. It's still the same as the one that you did for PEDAL. So we need to know how big the net assets of the sub were at acquisition and are now at the year end. As mentioned in previous recordings, we use the equity method to establish net assets, which means we start with the share capital, which never changes. Share capital was 100, so still is 100. Reserves were 400 at acquisition, and profits retained for the year were 200. So if we add that 200 to the 400, we find that the profits retained on the balance sheet at the year end are 600. It's a bit of a babyish question, so there's nothing else going on. So that 500 is the size of the entity at acquisition, and that 700 is the size of the entity at the year end. But this is not just the year end, it's also the point of the impairment review. The impairment review is going to reveal an impairment in goodwill. But first of all, we must calculate goodwill. So the fair value of consideration fair value of the consideration, which percentage terms is 100%, right? And we don't really need a working. It is slightly naff to have a working in this simple question, but what the heck, we'll have our standardized format. The fair value of consideration, which represents the purchase of 100% of the business, is given without a working by what we paid, which is 900 if I'm reading that right. A parent Fakenstock bought 100% of the equity for 900, yeah? So that's 900. And obviously there's no non-controlling interest, there's no NCI. So we compare the fair value of the consideration to the fair value of net assets. Oh, and that's what we've got up there, right? That's the figure of 500. So the 500 is compared to the 900 to give us goodwill of 400, at least at acquisition. So that's the goodwill at acquisition. But there's a big hint in the question that the goodwill suffers an impairment. And when we've accommodated that impairment, that will give us the goodwill at the year end, which is what we really need. The goodwill on the balance sheet, right? In order to calculate the impairment, we need to look at well, we need to look at the recoverable value of the subsidiary. And we need to compare it to this other thing called the carrying value. Now, the carrying value of the entire subsidiary is compared to the recoverable value of the entire subsidiary and the difference between those two numbers, calculated as a balancing figure, calculated as a balance. The difference between those two figures will give us the impairment of the subsidiary. And the impairment of the subsidiary is the impairment of the goodwill of the subsidiary. Okay, so, I mean, carrying value is quite literal. What two things do we carry as regards a subsidiary? Well, we carry net assets and we carry goodwill. So we carry goodwill and net assets. Now, what was the goodwill at acquisition 12 months ago? What was it actually? Was it 400? What was the goodwill at acquisition 12 months ago? It was 400. At the year end, 12 months later, before the impairment, what is it still now? Well, it's still 400 before the impairment. What about the net assets? Well, at what point in time are we doing the impairment review? As always, we're doing the impairment review at the year end. So how big are the net assets in this entity at that year end? Well, let's go and have a look. There they are at the bottom there, 700. So 700 is the net assets at the year end, and we are carrying both net assets and goodwill, so we're carrying 1100. But is that 1100 really worth 1100? Well, I don't know. How do you recover value from an asset? How do you recover value from an asset? Well, usually you would use it, but if you don't want it anymore, you can sell it. The two different ways of recovering value are to use an asset or to sell an asset. And the values, the technical names for the values that come from that are value in use and net realizable value, VIU and NRV. So that is, where are we now? 780 for VIU and NRV 350. Now, recoverable value is literal. It's the value that you will recover from the asset. And it's your asset, right? So you can do what you like with it. You can either sell it for 350 or you can use it for 780. Well, obviously what you're going to do is you're going to, choose to get the higher of those, because you can. So it's the higher of those two. So the recoverable value is 780. It doesn't matter that the NRV is 350 because you're not going to sell it. You're going to use it and earn 780. So the asset is worth 780, the subsidiary is worth 780, but that's a problem compared to the carrying value. It turns out the carrying value is an overstatement of the true value, and in fact the asset has fallen in value by a figure of 320, I think. I better just double check that. Excuse me. So what's that? 800, 300, yeah, that 320. Usual symbol for a balancing figure is beta. If you want to use that, that's cool. So 320 is the impairment of the subsidiary, but when you get an impairment of a subsidiary, which specific asset is it that falls in value? Well, the answer is, it's the goodwill. So 320 is knocked off the value of the goodwill to leave you with 80 on the balance sheet. And that's the answer. And yes, it does seem relatively easy. The problem with this, of course, is it has, insufficient complexities. There are 3 complexities that are missing from this question that are in pretty much every single group's question at P2 level. They are, first of all, an ownership percentage of less than 100%, and therefore an NCI. And the next 2 are kind of standard complications that come in at P2, which we actually pick up from F7. They're called the provision for unrealized profit, the provision for unrealized profit, and the fair value adjustment. Now, all 3 of these complications are to be seen in the question terror, and really, once you've done fake and stock, it's really all about terror. That's the important question. So let's have a look at terror. Apparent terror buys 70% of a sub, which generates an NCI of 30%, of course. Apparent terror buys 70% of a sub for 800 million at the year's start, when the share capital is 50 million, and that won't change. Reserves are 350 million, and a fair value adjustment, an FVA of 100, is required on machines with a life of 5 years. Now, fair value adjustments essentially are either depreciating or non-depreciating. If you have an FVA on land, then that FVA will be on the land, and the land is itself non-depreciating. So the FVA is non-depreciating. But this is not an FVA on land, it's an FVA on machines. And machines are depreciating. If the machines are depreciating and the FVA is on the machines, then the FVA is also depreciating, in this case over 5 years. The fair value of the non-controlling interest is given as 317 in this question. During the year, the sub made profits retained of 50, and they would have been retained on top of the original reserves at acquisition of 350, and therefore at the year end, the retained earnings at the year end would be 350 plus the 50 would give you 400, of course. During the year, the sub made profits retained of 50 and sold goods at 12 million to the parent with a margin of 25%, 1/3 of which is still inventory at in the parent. Now, during the year, the sub made profits retained of 50 and sold goods valued at 12 million to the parent with a margin of 25%, 1/3 of which is still in stock. So the sub has sold to the parent. The parent has purchased from the sub. The sub has sold to the parent. And this generates what's called the provision for unrealised profit, the PUP, the pup, the little baby dog. Rah! So we have a pup. But the way to calculate a pup is basically by taking those three numbers and multiplying them together. You take the 12, which is called the transfer price actually, and you multiply by the margin of 25%, and you find that the original unrealised profit on the transfer when the transfer took place was originally, you know, 1/4 of 12. It was 3. So the original unrealised profit at the point of transfer was actually 3, but we don't want that. What we need is the unrealised profit still unrealised at the year end. Well, how much of that stock which was transferred from the right hand to the left hand, how much of that stock that was transferred is still in stock in the group at the year end? Well, the answer is 1/3. 1/3 of 3 gives a pup of 1. So you have one little puppy and it's down in the subsidiary. And it affects the answer in the way that you'll see me accommodate that pup just now. We've almost finished. Let's just read this last sentence. Last 2 sentences. Goodwill has an infinite life, and a year-end review reveals a value in use of 360 and an NRV of 666. It is the group's policy to value the non-controlling interest at fair value, otherwise known as full goodwill, which, as I've mentioned in the previous recordings, is the assumption that we expect the examiner to make most of the time. So we can quite clearly see that it's the group's policy to value the non-controlling interest at fair value because he actually gives us the fair value of 317 in the first paragraph. So he's telling us to use that 317, which of course we will. We will use that 317 in generating the goodwill, but another feature required in the goodwill is net assets. So the structure of Terra is very similar to Fake stock. We need the net assets at acquisition and at the year end. The share capital doesn't change. No, it doesn't change. It was 50, and it'll still be 50 12 months later at the year end. Reserves, of course, change. They were 350 according to paragraph 1, and according to paragraph 2, 50 was retained on top of that 350. giving us 400 12 months later. But not only do we have those basic elements of net assets, we also have the FVA and the PUP. Now you would be expected to abbreviate those in the exam. That's FVA, fair value adjustment, PUP, provision for unrealized profit. Okay? You don't really need to mention the asset on which the FVA occurs, but personally I find it easier if I do. The original FVA was a figure of 100. It was 100, wasn't it? Yeah, it's in that first paragraph there, in the middle of the first paragraph. And as it quite clearly says, it's on an asset which is depreciating. The asset is itself depreciating over 5 years, so the FVA will be depreciating over 5 years. 100 divided by 5 gives us 20. So 20 of the FVA would be knocked off the FVA, knocked off the balance sheet into the income statement, knocked off the balance sheet, and we'd be left with 80 at the year end, 12 months later. So minus 20 for depreciation gives us 80. And these workings that I'm showing here, although they are brief, they are completely sufficient. Please don't over-explain yourself. If you over-explain yourself in question 1, you'll run out of time. You've run out of time in question 1, let alone in the B section. Please be very careful to explain yourself, but explain yourself very, very briefly. Have really brief workings. Like, for example, this calculation, the PUP is going to be really, succinct. All I'm going to show the examiner is the transfer price is 12. The margin, giving us the hidden profit, is 25% of that 12, and 1/3 is still in stock, giving us 1. That's it. That's all the explanation that is required at P2. So we can now find out how big the entity was and how big the entity is. It's 400, 500, or was 500 at acquisition, and 450, 530, 529, 12 months later when the impairment review takes place. If you take a look at the requirement, this one asks you for goodwill. Asks you for goodwill and NCI, right? But it asks you primarily for goodwill. So let's calculate goodwill. So the fair value of consideration represents the purchase of 70%, right? And that means that the NCI must be 30%, and obviously the whole business is 100%. So that's my percentages done. Again, I have to be honest with you, sticking in a working here, sticking in space for a working here is clearly gratuitous. There's no workings actually to be done in this case, but there may be in your exam, so give yourself some space to do so. So we have a working there. Excuse me. The fair value of consideration was given by the examiner, 70% for 800 million. So 800 million is the fair value of our chunk of 70%. The fair value of their chunk is 317. So the fair value of the whole business is 1117. The fair value of the net assets, well, that's this 500 that you've calculated in your net assets working. So you've got a goodwill at acquisition, fairly strange figure, 617, right? That's the goodwill at acquisition, but it suffers an impairment at the year end. And in order to calculate the impairment at the year end, we need to take a look at the recoverable value of the whole subsidiary. So that means this working. What two assets are we carrying when we carry a subsidiary? We carry Goodwill, which we've just calculated. Oops, Goodwill, 617. But we also we also carry net assets, which we calculated previously to be 529. Oops. I can see that my trusty calculator is required now. Fortunately, I have my Casio hidden in my suit pocket. Thank goodness. So 617 plus 529 equals 1146. Like I say, it's a bit of a shock for me to use a calculator, because normally what I'd do is I'd ask you guys to do the calculation. But you're not here, are you? So I have to do it myself. So I've done it myself. And, well, you can see the story there. The value in use is only 360, so we're not going to use it. We're going to sell it, and we're going to make 666. So 666 is the recoverable value, 666, and that gives an impairment of 480. A fall in value of the entire subsidiary of 480. But which asset is it that takes the hit? It's the Goodwill that takes the hit. There it is. So minus 617, and that leaves you with 137 on the balance sheet. And it has to be a small positive goodwill that's left behind on the balance sheet in question 1, so that the markers can mark it. Now, it's difficult to know exactly how many marks that would be worth in the examination, but something of the order of 5 or maybe even 7 marks, it's possible. Probably 5, I would suggest, but it certainly could be as high as 7 marks for that 137. So it's well worth being comfortable with this. Speaking of comfortable, I feel slightly more comfortable if I actually write down what I said aloud, which was, you know, VIU was 360. And NRV was 666, and we used the higher, didn't we? Yeah, and there we go. That does make me feel slightly more comfortable, although I have to confess, in the exam you probably wouldn't be bothering with that kind of nonsense. You're trying to go as fast as you can, right? It's obvious that 666 is the higher of the two, and therefore you just use it in the exam. Now, well, you're not at exam standard yet, but what you do have is you have two separate little buckets of knowledge, which is heading towards examination standard, and that is, you've got your parent, subsidiary and associate in one hand, and you've got your goodwill impairment plus the FVA plus the PUP in the other hand, right? Given to you by the question pedal and the question terror. Now what you can do is you can bring that knowledge together. First, you should practice pedal. Make sure you're very, very comfortable with it. Make sure it becomes easy. Then practice terror until that becomes easy. And then bring the two of them together. Now, I mentioned this in the last recording, but I'll repeat myself again. This chapter, like other chapters, has supplementary questions that I will not be recording to video. And also, to be quite frank with you, I don't teach to the evening or weekend classes either. And a good example of one of these questions is over the page, a couple of pages. It's a lovely question called Hebrides. And it's a wonderful homework question that is a homework question for you guys, and also a homework question for the weekend and evening students who are studying with me face-to-face here in London. Now, just to remind you of a very important feature which one or two students don't pick up until towards the end of the course, and that is there are full answers in the back of the book as regards all of these exercises. Clearly, the real answers that you want are the ones to the supplementary exercises, right? The ones that I don't teach to video. But there are also answers to all of the questions I do teach to video. So if you go and look in the back, you'll find that there's a full answer to terror. In fact, actually, when you look at my answer to terror in the back, you'll notice it's really quite expanded, far more than I could ever record to video. So the most important thing, definitely the most important thing, is to make sure you're comfortable with everything that I record to camera. I'm always recording the most important things to camera. But if you happen to be studying just P2, or you have an excess of time available and you want to spend more time studying P2, then you can supplement your studies not just by repeating the video questions, but doing the extra questions as well. Like, for example, this one called Hebrides. It looks like Hebrides, but it's actually called Hebrides. It's supposed to be based on Scottish Islands. As you can see, it's Hebrides, Skye and Arran. Okay, so I recommend that to you as homework, if you have time, and I hope you do. Speaking of repetition and recommendations, I also want to remind you, please do have a look at the introductory chapter. This is chapter 1 we're doing, right? But before that, there's an introductory chapter. Now, to be quite frank with you, the introductory chapter, it's really for you. I mean, obviously I make it available to the taught students that I teach face-to-face in London, but it's really for you guys that I've produced this introduction to the paper. And I think it'll help you to get a flavour for this paper and get you, sort of more tuned with the examination and the examiner if you can have a look at it. It goes through the format of the paper, the examinable documents, past exam questions, and also, very important, there's interactive student advice, which is advice for you guys, right? So I'm just going to repeat what I said on the last video, which was I do highly recommend you take a look at the introduction to the paper. It is for you guys, and I hope you find it useful. Okay, that's the end of that recording. When we come back to the next recording, we're going to start to look at changes in ownership. So we've finished Goodwill impairment. Next up, changes in ownership.